Hello everyone, welcome to my first lesson in financial accounting. In this 10-minute session, I'll provide you with a general overview of financial accounting. By understanding these foundational ideas, you'll be better prepared to navigate your entire study journey in financial accounting smoothly. Based on my teaching experience, I have created my own course outline that caters to the needs of most students studying financial accounting. We'll start by delving into the key accounting equation and making double entries in the following few lessons. Then, we'll move on to certain types of assets, then liabilities and equity, and finally, the cash flow statement. Now, let's begin with a general description or definition of financial accounting. Financial accounting, in simple terms, is the process of identifying transactions for a company and recording them in accounting systems to prepare financial statements for a specific period. The key words here are record transactions and prepare financial statements. I am going to start with the end products of financial accounting, the financial statements. Once you understand what the financial statements are and their purposes, you'll better appreciate why we do certain things right from the start, and you'll have a preview of the whole process. There are four main statements in the complete set of financial reports. They are the statement of financial position, also known as balance sheet, income statement, statement of cash flows, and statement of changes in equity. In the remaining part of this video, I will briefly introduce the first three statements and then provide a case to explain more about their functions and relationships among themselves. We'll focus more on the first two initially, since almost all transactions affect each or both of these two statements. So, let's dive into the first statement, the statement of financial position, balance sheet. This statement provides a snapshot of a company's financial position at a specific point in time. It lists the company's assets, liabilities, and equity. Assets are the resources owned or controlled by a company, which are expected to generate economic benefits to the company. Examples of assets include cash, inventory, and motor vehicles. Liabilities, on the other hand, are what the company owes and expects to settle by cash or other resources in the future. These can be unpaid bills, loans, or tax payables. Equity represents the owner's residual interest in the assets after deducting liabilities. It's essentially the net worth of the company. It typically at least consists of capital contributed by owners and accumulated profit or loss since its incorporation, known as retained earnings. The balance sheet is typically prepared at the end of a month, quarter, or year, giving us a snapshot of the company's financial position at that specific moment. Now, let's explore the fundamental equation in financial accounting. Assets equal liabilities plus equity. This equation signifies that when a business acquires an asset, it must obtain funds, liabilities, from external sources or use the owner's capital, equity, to finance the acquisition, or a combination of liabilities and equity. For instance, if a business purchases a motor vehicle for $10,000, it can be financed by a $5,000 loan, liability, and a $5,000 investment by the owner, equity. We'll delve deeper into this concept in our upcoming lessons. Moving on to the second statement, the income statement. This statement showcases a company's financial performance over a specific period, detailing its revenues, costs, and expenses, which ultimately result in net profit or loss. Revenues represent the income generated by the company's main business activities, such as sales of products and service income. Expenses and costs, on the other hand, are the resources incurred in business operations, for examples, the cost of goods sold, salaries, office rental, and utilities. Net profit is the difference between revenues and expenses, reflecting the amount a company earns after a period of operation. It is usually measured over a month, quarter, or year. Now, let's move on to the third statement, the statement of cash flows. This statement provides information about the cash inflows and outflows over a specific period. It helps us understand how the company generates and uses cash, allowing us to analyze why the company's cash balance changes compared to the previous period end. The statement of cash flows consists of three main types of cash flows: operating activities, investing activities, and financing activities. These categories help us understand the sources and uses of cash within the company. Let's quickly recap the key elements of the three financial statements: balance sheet, income statement, and statement of cash flow. Before we move on to the examples, if you found this video helpful, please give it a thumbs up and subscribe to our channel for more accounting tips. Now, let's dive into a case study to illustrate how transactions are captured and reflected in the three financial statements. This case study will highlight the interconnectedness of the financial statements and how transactions impact them. Assume it's January 1st, 2024. I'm starting my own limited company in the kids' football training business. On the first day, I inject an initial capital of $10,000 into the company as startup funds in exchange for ordinary shares issued by the company. Additionally, the company borrows $5,000 from my best friend. As a result, on January 1st, 2024, my company has $15,000 in cash as assets, $5,000 as a loan liability, and ordinary shares $10,000 as equity. Throughout the year 2024, my company generates revenues from sales of football jerseys amounting to $2,000 and training course fees, totaling $8,000. It incurs costs of $1,000 for the jerseys purchased from suppliers, $5,000 in salaries paid to coaches, and $1,000 for rent on a football pitch. Over the year, the company records a total revenue of $10,000, with costs and expenses totaling $7,000. As a result, it earns a net profit of $3,000. In addition, at the end of 2024, since the company has surplus funds, it repays $1,000 to my best friend. Now, let's see how these transactions are reflected in the financial statements. First, assuming no dividends are paid, the net profit of $3,000 is fully retained by the company and becomes its retained earnings. Since all the revenues received, costs, and expenses paid in my case are in cash during 2024, the cash balance increases by $3,000. Additionally, the partial repayment of the loan, $1,000, reduces the total loan balance to $4,000 as of December 31st, 2024. Putting it all together, the cash balance increases from $15,000 to $17,000 by the year end. Lastly, let's look at the statement of cash flows. The $3,000 profit earned from the business is classified as operating activities. The initial capital of $10,000 contributed by myself and the $5,000 loan borrowed from my best friend fall under financing activities of the company. With a partial repayment of $1,000, the net cash from financing activities is $14,000 over 2024. The cash balance as of December 31st, as shown in the cash flow statement, is $17,000, matching the cash balance in the balance sheet. This case study demonstrates how transactions flow through the financial statements and how they affect the company's financial position, performance, and cash flow. I hope today's lesson has provided you with a basic understanding of financial accounting, specifically the purposes of the balance sheet and income statements, as well as their connections among the financial statements. In our next lesson, we will dive deeper into the accounting equation and the preparation of double entries to record company transactions. Thank you for watching. If you have any questions regarding today's video or financial accounting in general, please leave your comments here. I'm here to help and provide further clarification. Additionally, if you enjoyed this video and found it helpful, please don't forget to click like and share it with others. Stay tuned for the next lesson, where we'll continue our exploration of financial accounting. See you soon.